Folks, you better get ready. In today's video, we've got a very important message for all stockholders. We're going to be going through market data, why market choppiness is getting crazy, what history suggests. We're going to talk about why we're getting into a new normal and how to adjust to it and exploit it for your own advantage. Then we're going to go on to the best deals on stocks that we see right now. And then finally, for the main entree, we're going to go on to one specific stock that I believe is screaming buy right now. This is a stock that's been discounted about 70% from all-time highs, has bounced off for years levels that it's currently at. I'm going to make my case for this stock and let you be the judge. As always, if you're the one taking the ultimate risk, you've got to be the one doing the ultimate frisk. Always do your own due diligence for all ideas presented. Also, quick plug, we are officially starting our $100 off Black Friday sale on the Discord. Get $100 off annual membership when using that first link down below. As a member, you'll get access to all of our ideas and alerts, our stock briefings, our daily morning briefings, our price targets, our model portfolios, our urgent news and Catalyst AI bots, and our 10+ hour video lesson library. Anyways, we'd love to have you on the team. Make sure to join with that first link down below. Okay, let's get to work. Okay, so markets are increasingly down in the dumps. The November choppiness has become more and more of a trend and fear is climbing. But this is a good thing. Choppiness and sell-offs tend to scare many folks out of markets and create the biggest upside opportunities upon reversal. I understand that there's a lot of folks that come into the market and are only interested in the market during the shining periods where the sun's out and everything's great, and when the rain starts, they're the first to run back home to mom and papa. But they don't realize this is all routine. Now, why exactly are we dealing with choppy McChoppy right now? A few reasons. There's more doubt on the December rate cut. There's data fog, which means investors and the Fed are driving blind because of the government shutdown. You have a lot of data that just isn't coming out. And then you have valuations that have climbed without breathing. You need to see regular breathing or people freak out. And then we skipped the typical early fall sell-off that has happened for like the last 80 years. Usually in September, you have a down month. This year, we skipped that, and October was also strong. We had an Uptober. So people right now are like, okay, well, are we overdue for a fall sell-off? And you're seeing some of those people start taking profits and de-risking a bit. However, I think the biggest reason of these four is really the doubt on the December rate cut. Now, you got to remember, Fed rate cuts have a massive impact on the value of stocks. The interest rate has a direct impact on the multiple that people are willing to pay on sales. A lot of people think, oh, this company, it's doing so much better because it's going up. But a lot of the times, even if the sales numbers are just going up 20 to 30% a year, the stock can go up 5 to 6x in that year if the interest rates are getting cut massively. However, when rate cuts start slowing down, or when markets think they're going to slow down, that means that the future value of these companies get crunched. They get absolutely destroyed. That's why if you were around back in 2022, well, you saw massive rate hikes crunch, absolutely crunch so many stocks that were excellent companies, but they were crunched 50% down or more simply because multiples were crunching. People are like, hey, if interest rates are going to be hiked at levels we've never seen before, that means we have to discount these companies at levels that never made sense before. Right now, we're in a completely different era than we were back in 2022. The slowdown of rate cuts and the new higher for longer talk is causing a lot of people to capitulate, but unlike in 2022, the overall trend is nonetheless that we're going to see more and more rate cuts and more overall easing. A lack of a December rate cut means little long term. Fed fund futures are projecting that sure, December might not be a lock-in for a rate cut, but the next few meetings in early 2025 are going to be, and by the end of 2025, you're expected to go down substantially. So markets that are selling right now and cooling down because of these fears, well, sure, there's reason to do that algorithmically speaking, but at the end of the day, this is going to end up being an arbitrage opportunity. Now look, in my last video, I gave my prediction for 2026, and that prediction was that you're going to see a beautiful overall uptrend that ends the year higher, but way more frequent, severe, sharp pullbacks. And this is going to be a new normal that you're going to see and you're going to have to deal with and you're going to have to plan for. It's also going to be a gold mine for people that know how to strategize and actually benefit from volatility instead of be destroyed by it. Sadly, in every bull market, you see a lot of people come in and they're really only interested in getting instant returns without any kind of volatility, without any kind of research, without any kind of understanding of what they're buying. Well, all those things sound great, but you're living in unicorn land. That's just not how things work. And the faster that you can understand this, the more you can understand that these big dips and these sell-offs are actually features of markets. They're not drawbacks, they're features. They're things that you can exploit to your advantage. Let everybody else that just wants to buy and not think about what they're buying lose their money. It's up to the people that actually want to do the work and actually want to understand the bigger picture that are going to do well in the long term. Okay, with that being said, now it's time to get into the 4 best deals that we see right now. Let's start with Chipotle CMG. Now, as you know, Chipotle, or as I like to say, Chipotle, is a popular restaurant chain with more than 3,500 locations focused on premium, customizable burritos, bowls, and salads. It's one of the rare restaurant brands with pricing power, digital dominance on delivery apps. It ranks first in most delivery apps, and 0 franchise exposure, meaning tighter quality and higher margins and a pretty good name brand. Now, Chipotle operates a vertically controlled restaurant model with strong digital ordering, new drive-through pickup lanes called Chipotle lanes, and an expanding international footprint. Their digital loyalty ecosystem is one of the largest in the industry. Now, I'm a big fan personally. I order their burrito bowls at least once a week, but I usually don't talk about their stock. However, right now, because their stock is trading at such a discount, in my opinion, it's an unbelievable deal. And despite this dip, Chipotle continues delivering double-digit same-store sales, expanding margins, and 150 to 200 new stores per year are opening, even more for 2025. This pullback is giving long-term investors a rare opportunity, and I'd argue it's very quality growth at a discount, a massive discount. Chipotle rarely goes on sale, but when it does, historically, these dips have been phenomenal long-term entry points. Now, Catalyst, you have new store expansion plus Chipotle lanes additions, which makes it easier to pick up Chipotle because you can just drive through the little drive-thrus, and you have to order online, but then you drive through and pick it up. And then you have international growth through Europe and the Middle East. You have menu innovation and seasonal promos. You have digital order growth, and you have buybacks plus rising margins. Now, CMG, I think, is a very, very good addition to many portfolios, and it's a good diversification play away from tech so that your portfolio has a little bit of diversification when tech is crawling back down. Your CMG is a classic compounding machine. Short-term macro fears have been pushing it down like a dog, and there's some fear over consumer spending pushbacks that I believe are going to be temporary. But long-term fundamentals here have never looked stronger, and I'd argue if you're buying the dip on this right now and you're simply holding it for the next few years, you're going to do well. Now, in terms of call options, we are going to be alerting CMG calls shortly after I post this video, so if you're a Discord member, make sure to check into those. Okay, next, stock 3, Applied Digital, ticker symbol APLD. So data center compute demand is not going anywhere but up in my view, but APLD stock has been sold off so aggressively, it's ridiculous. I believe the bears are simply wrong here, and I believe there's going to be a big arbitrage opportunity soon. The context on this is we screamed it as a buy last time short sellers decided to dump on it. At the time, the stock was at $4.53, and investors were told by the media that if they bought this data center play, they would lose everything. They said, obviously, AI must be a big, massive scam. Probably internet and computers and all of those things are just fads as well. So what's the point of data centers? Data centers are scams, the media said, and a lot of the short sellers said. And a lot of people looked at that thesis and they said, yep, that must be true. And they sold out of the stock at terrible levels. But we said, no. At $4.53, this is an obvious buy. Stop listening to the BS. And what happened afterwards? Well, actually, the stock nearly 10x'd over the coming quarters. It went from $4.53 to just over $40, which is absolutely insane. But now we're back in the low 20s, and people are saying the same thing again. This is actually why I love high growth, high beta stocks, because it's always the same game. Oh no, this stock needs to go to 0. And then people sell it off 90%. And then, oh no, this stock has to go to $1,000 per share. And then people overbuy it. It's like the same thing back and forth over and over again. But in the long term, what matters is the bigger picture of the value creation that these companies can have. Not how many years in the future it's going to factor in, but really what it's actually creating. And this company is creating a lot of value in the data center space. So anyways, now we're back down in the 20s. I want to give you a good idea of why there's a lot more upside for the stock. And the catalysts that could drive major upside, in my opinion, are new lease contracts for massive megawatt capacity with AI enterprise clients and hyperscalers. Each major win expands the recurring revenue base, and they've been doing that very, very well all year. Campus expansions, bigger data center facilities coming online with power/cooling ready, enabling the next wave of compute demand. GPU demand surge. I think you're going to continue to see this space heat up aggressively as AI model sizes balloon and supply remains constrained. Companies will pay premium to rent capacity versus building new. You have energy/efficiency advantage if APLD has the power cooling advantage, which I think it does. It has a lower cost per compute unit, while margins will expand as utilization rises. And then, of course, you have the overall macro tailwind. Data shows almost everywhere that the entire AI infrastructure market is still in the early innings and spend is only going to increase. Okay, stock number 2, RGTI for Rigetti Computing. Now, quantum computing is back in its dysphoria cycle phase. Now, a lot of people look at quantum stocks and they think this is way, way, way too speculative. I don't want to touch this. However, what you got to understand is that if you do choose to play these types of stocks, well, you're essentially betting the computing side of the AI arms race is going to continue to see inflows. And I don't just mean from the private sector, which you're seeing a lot of evidence of that, but I also mean from the public sector. I'm a big believer that we're in what's called an AI arms race. And in the AI arms race, those with the most computing power are going to be those who win and are going to end up being the ones that have the most powerful companies, economies, countries, so on and so forth. And I'm a big believer that net and in effect, the US will at least match, if not exceed, the massive Chinese investment that's going into quantum research over there. And so even if the private sector decides to shite on quantum, I'm not exactly worried about that, but I don't think that's what's going to happen. And I think that there's arbitrage with that. Again, these are very speculative plays and a lot of people don't like them because they're speculative. But I actually think, again, that the speculation and the volatility here is really a massive opportunity because these companies, they can run up just by winning milestones in the computing arms race. Of course, they are sensitive to interest rates, but again, that's another arbitrage opportunity. And again, this is what I've been saying for a year plus now when it came to quantum computing, and we've been right. This is what we said in December 2024 when we said that RGTI has way, way more to climb. It had just almost hit $10. This is something that we said again in April when RGTI got beat down all the way back to $8.57. We said, look, it's a great buy. It's going to have more upside this year. That's what we said in June when we said RGTI is still a buy even though it ran to $13 already. And this is again what we said in September when we said RGTI was about to break $20. Well, guess how far RGTI ended up running? It ran all the way to $58.15. Now, a lot of people say you were wrong on this play because now it's in a cool down cycle. But again, just because something went way over the expectations over a shorter time frame than expected doesn't mean that we were wrong on it. And it doesn't mean that it doesn't have a long-term upside that far surpasses its all-time highs. And the emotions with these types of stocks and the speculative nature of them and the sensitivity to rate hikes is actually a feature and a tool of these stocks, not something to fear. Funny thing about growth stocks is had this stock never run to $58 and just stayed within the range that we laid out, slowly climbing, which was our original prediction, by the way, well, we could have avoided this big dump that we just had. But instead, we went to $58, and so you set it up for a massive dump back to the levels that it would routinely revert to anyways, which means that now a lot of people don't like the pick. But again, when you're looking at the longer term, bigger picture, who cares? These are all tools and opportunities. Again, I'm a big believer in the long-term upside for quantum, and RGTI is one of my favorite picks. And I think that once we get back into this range that we laid out months ago in the mid to low 20s, it'll be ripe for a beautiful resurgence. Sure, it can be overcorrected, but long-term, what are we looking at? We're looking at levels that could be much higher. And the arguments that I've made for RGTI still stand, whether you're talking about market tailwinds, tech leadership, manufacturing moat, tier 1 customers and partners, and strong financial backing. Okay, now it's time for stock number 1. TTD, the trade desk. This is the main entree. So TTD is now trading at just under a 70% discount from its highs reached in December of last year. We are hitting key support levels in the low 40s that TTD has for years aged to be a great buy at. Now, backing up, what exactly is the trade desk? Well, the trade desk is one of the leader players in programmatic digital advertising technology. It provides platforms that enable advertisers to buy media across video, connected TV platforms, mobile, and other digital formats with data-driven precision. Now, the current drop in TTD's share price has much more to do with short-term macro fear, rate cut delays, and worries that advertisers are pulling back temporarily, but isn't based on anything long-term, and its underlying business model is very, very good. Now, the reason that I think it's important to talk about right now is not just because we've reached levels that TTD has historically bounced off of, but also because TTD tends to do very, very well during the holiday spend season. Because why? Well, lots of advertisers like to boost their budgets during the holiday shopping season. Now, let's be clear. If you're looking at the bigger picture here, digital ad spend isn't going backward. A lot of people don't like TTD because they're thinking, oh, okay, well, ad spend must be done on the internet. No, that's not the case. And this company has the connection pretty much across the board to really get customers that no one else can. When it comes to connected TV, ad spend there is exploding. When it's coming to programmatic advertising, that's taking share every quarter. Retail media, expanding rapidly. Open internet advertising, that's growing as brands diversify away from traditional walled gardens. And TTD sits at the intersection of every single one of these trends. Now, again, whenever the ad cycle turns upward, TTD is one to benefit disproportionately. And that is exactly what's about to happen. You have Black Friday, you have Cyber Week, you have Christmas shopping, and you have January clearance rushes. From now until January, you really have a beautiful spending season. And during this time period, you have the highest intent customers ever. And brands know that. TTD has already opened openly publish guidance on how advertisers should use retail data for holiday shopping, how to win electronic shoppers, and how to target high-intent gift givers. And remember, these campaigns run disproportionately on programmatic and CTV, exactly where TTD is the strongest. When holiday ad budgets pop, well, the Trade Desk does tend to as well. Remember, high-intent shoppers means high-intensity spend, which means high amounts of money for the Trade Desk. And I think they can use this as a bouncing board to not just recover share price, but also really bounce their overall business for 2026. Now, the other part of this is you have to understand the deal that you're getting with TTD right now. When the Trade Desk was trading at 30 to 50x sales with euphoria baked in, well, the risk was sky high. But today, if you look at that same price to sales ratio, it's at just 7.84. That's way below where it is historically traded at, which means not only is this company doing solid business-wise, but you're also getting way more for every dollar invested into it. So overall, I'd argue that the downside here is pretty small and the upside is pretty large. TTD is a company that's a leader in its space, has panic pricing, has a major holiday catalyst, and has massive long-term runway. So I believe very solid buy, and I'm going to go ahead and alert calls on this shortly after posting this video. Anyways, folks, that caps off today's video. Make sure you take advantage of our Black Friday sale on Discord membership with that first link down below. Get $100 off, and we'll see you in the next one.